Tony, I'm turning 73 next year and nervous about taking the required minimum distribution. I have 3 separate IRAs and wondering how the RMD is calculated.
So the RMD, I'll have to admit, when I talk to our tax certified specialist, TJ Reagan and LeAnn Tinsley, the most common worry or concern about even our clients is what to do when they turn 73. Well, let's take a look at this. Let's say you have IRA number 1, it has $200,000. Just had someone call in on this just now. Has a 401k of $100,000. She's getting ready to retire. And then she has an IRA of about another $30,000. She's 68 years of age. So if we total that up, that's $330,000 of pre-tax qualified money. Now again, she's not 73 now. We could still do tax planning around this before RMD age, which with these low tax rates, I would suggest doing. But let's say she says, nah, I don't want to do anything. Just let them grow, Tony. They invest them with us. And maybe at age 73, let's say this one's grown to 250. These are just hypotheticals. 120, and this one's grown to 45. So now it's 73. So what the IRS requires us to do, what we would do in the offices, especially if we have everything under one roof. What's scary, folks, if you've got IRAs spread out with different advisors, one hand might not know what the other hand's doing. So in this example, what is that, 370? We'll just call it 400 just to round it off. So the factor for the first year, now this is ballpark. The factor for the first year is 4% of that amount. So that year, roughly, the RMD, what you have to take out, the minimum you have to take out to pay taxes is $16,000. So it's not as bad as you think. Now, that will go up every year. The idea is the IRS wants their tax revenue, so they're going to force you to take that out. So it will go up every year. But you might look at those assets, and this is where Tony Walker Financial, this is where it's really cool. Because we might have 3 different types of investments, all IRAs, all pre-tax, going on. So let's imagine we got to take $16,000 out, and let's just say we had this in our growth fund, and maybe it was down a little bit. Well, we don't want to take it out of there while it's at a loss. Maybe this has been in an annuity and gone up a little bit over the years, and maybe this one's kind of flatlined, okay? So we're looking at this, and our own LeAnn Tinsley, who calculates these every year for our clients at no charge, comes along and says, well, Tony, looks like we're going to take the $16,000 from the account that's not doing much, or we could take it half and half from the account that's grown and maybe the one that's not doing much and leave this one alone. So I guess the answer to that question is you can pick and choose where to take the distributions from in which IRA, but it has to equal that $16,000. Oh, incidentally, I know this wasn't one of our questions, Aaron. I got to throw this in. Keep in mind that even if you're 70 and a half, let me write that up here. This is a cool thing you might want to consider. If you're 70 and a half, assuming you're charitably minded, you can do something called a QCD or qualified charitable distribution, and it doesn't even hit the tax return. And you could do up to $100,000, donate that money to charity, keep it off your tax return, and what that's going to do is lower those amounts, so when you hit 73, it's going to lower your RMD. So whether you're eligible or should be doing this QCD really depends on your situation, which is why, again, I would encourage you to contact us for that free appointment, that second opinion at TonyWalkerFinancial.com, or simply call the number on your screen.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips, and be sure to hit that like button and that subscribe button for more videos.